Today I want to talk about the difference between fully insured and self-funded. It's crazy to me how scary the word self-funded gets to people versus fully insured. Even staff members that have been employed 2 or 3 years, they're like, I just can't grasp the difference. It's really, really simple. You know, when you're fully insured, you pay the insurance carrier, whether it's Blue Cross Blue Shield, United, or Cigna, you pay them the premium on January 1st for your January coverage. And they process your claims, they cover the risk, they send ID cards, and they do customer service for that one premium. When you're self-funded, you send an administrative fee to a self-funded administrator to process your claims for you. You set up a bank account with that processor where they draft money out of your account to pay the claims as you go. And you send a reinsurance premium to a reinsurance carrier that covers claims if they go over a certain amount. So let's say a $75,000 reinsurance deductible. If a claim goes over $75,000, they eat the balance. What terrifies everybody is, well, if I go self-funded, what if I had $1 million claim? What if I had a $10 million claim? You can't have $1 million claim because we bought reinsurance on every claim $75,000 and above. Well, the next question that comes up is, what if 10 people have a $75,000 claim? What if everybody in the group has a $75,000 claim? Well, we also have aggregate reinsurance, which says if all the claims below $75,000 exceed a certain amount, then the aggregate coverage jumps in. It's an alternative way to pay your premium that gives you financial advantages and lets you keep the difference. The reason every single Fortune 500 company is self-funded is because there's advantages. Let's talk about them. There's a 7.5% tax that is charged on every type of insurance premium you pay for health insurance. 3% of that 7.5% goes to the federal government to help cover the exchange. 2.5% goes to the state insurance department, and 1% goes to PCORI, which stands for Patient-Centered Outcome Research Institute, which is a healthcare reform derivative to help solve dread diseases. There's a $63 fee per insured member to cover the insurance exchange administration, which I say comes out to about 1%. That's how you get to your 7.5%. One of the huge advantages of self-funded is that you don't have to pay the 7.5% tax on anything except the reinsurance premium. You don't have to pay it on the administrative fee, and you sure don't have to pay it on the claims, and the claims are 80% of the payout. The second is you get to design the plan exactly the way you want it. You don't have to buy coverages you didn't want. Coverages such as in vitro fertilization. Maybe you wanted Viagra covered, maybe you didn't want it covered. Maybe you wanted a better chiropractic, you didn't want as good a chiropractic. So all of these different things, you can design your own plan the way you want it. There's cash flow on your money. When you pay with a fully insured carrier, you pay your premium at the beginning of the month, and they may not pay the claims for 2 or 3 months, afterwards. When you're self-funded, the money's sitting in your account earning interest until we actually have the claims and pay it. There's a 3% average underwriting gain, which means the carrier collects 3% more premium on average than they spent on claims, administration, etc. And so that 3% stays in your pocket. And then there's also, on every name brand drug written in America today, there are what we call drug rebates. Those drug rebates are going to the insurance carrier. When you're self-funded, they come to you, the client. If you add up all those percentages together, it's a 13% advantage each and every year to be self-funded. So to simplify, what is the difference between fully insured and self-funded? One is a pay up front, and they get to keep the money. The other is pay as you go, and if there's any money left over, you get to keep it. It's that simple.